So weighted average cost of capital. Fine, because the company can deploy, either capital from equity or from debt or a hybrid source of, capital. So ultimately, the weighted average cost of capital is the total cost of capital of the company. From each source, we calculate what is the cost of that source, cost of equity, cost of debt, okay, and what is the weight. We apply that weights and calculate the cost of capital. It's a very simple one, okay. So we can use the individual cost of capital that we have computed to get our average cost of capital. So for any company, so weighted average cost of capital. So what we are doing, okay, fine. Now it's visible on the screen. So we have to calculate what is the WACC of a company. WACC is a very important term, which we always use. What is the total cost of capital of a company? The average is the required return of our assets based on the market perception of the risk of the assets. So that means whatever is the weighted cost of capital, that becomes the expected return on what we should get from whatever business we are doing, or whatever business or whatever assets we are deploying. So that much of return we should. So suppose my cost of capital is 15%, weighted average cost of capital. So that means I should get at least 15% return on whatever assets I have deployed in the business. If I get more than that, that means the shareholders will be delighted. Okay, if I get less, so they will get less return. So shareholders may sell the shares and exit from the company, and I'll not be able to raise more capital. So weighted average cost of capital assumes a great significance. The weights are determined by how much each of the financing we use, each type of financing we use. Okay. Now, first we have to give the weights. Market value of equity, okay, which is called E. Okay, equity ki kitni market capital hai? That is the number of outstanding shares times the per share. Okay, we'll do that. D is the market value of debt, how much debt we own. Okay, and V is the value of the firm, or total value of the market value of the debt plus equity. Okay, I'm going to explain that, don't worry. So we calculate the weights. So E divided by V, percent finance in equity, percentage finance in debt. How much you are using debt, how much you are using equity. So ultimately we have to derive the weights. Through an example, you will be able to understand it more clearly. Now suppose you have a market value of equity equal to 500 crores. So this is your market price of your shares or market cap. And market value of debt is 475 crores. So whatever loans we have taken, what is the current value of that loan? Because I told you, suppose you have taken a loan about 3 years back at 9%. But suppose today you take a loan, you have to pay only 7% because interest rates have come down. So you have to recalculate your market value of debt. So I'll tell you how to do that. So then we do this simple calculations. 500 crores is the value of equity. 475 crores is the value of debt. So 970. So E upon V. So you are 51% of your money is financed through equity and 48% is through debt. So this will become your weights. Now we will have each source of capital and its cost of that capital, cost of equity and debt. We multiply and then we add. We get the weighted average cost of capital. Now, for debt, whatever is the cost of debt, since it is tax deductible, so we will apply the formula. If KE represents the cost of equity, KD represents cost of debt. So KD 1 minus T will be doing. This formula we need to show. Whatever is the T, we have to add that T here. Tax is 30%, 25%, so we have to just put that. Okay, suppose for example, you are paying, suppose 10% interest on loan, and your tax is 30%. So that means KD will be 7%. KD is 10%, 1 minus T, which is 1 minus 0.30. So 70% of 10%, that means your cost of debt will be now 7%. Suppose you are taken a loan from a bank, just taken a loan, so that is your current cost. You are paying 10% interest on a bank, to the bank. And suppose your tax rate is 30%. So cost to the company will be only 7%. Isn't it? 10% there is 30% tax rate hai. So ultimately outflow will be only 7% from your pocket of the company. Because company is going to save tax on that, which I explained in the last example also. Is that okay? So now, so this becomes your weighted average cost of capital, where we use the weight of E multiplied by cost of equity plus the weight of D, which is the debt, multiplied by KD into 1 minus TC. So that will become your WACC. Okay. So let's do one example. Okay. And this example is very good, and similar like questions will be there in your exam. So equity information is given to you. 50 million shares, 80 rupees per share is the current value of the share in the market. Beta is 1.15. Market risk premium is 9%. Risk-free rate is 5%. So you can easily calculate. And debt is given separately. So there is information for equity and information for debt. 1 billion in outstanding face value of, you have issued debentures. You have issued bonds now to the public. So people have bought bonds. Value of the bond is 1,000 rupees. Current quote of the bond is 1100. The bond which you issue to the public, if you buy it from the market, it is available at 1100. Do you know why it goes to 1100? Because why it happens is that the bond which you issued, the bond was issued for say 10 years at 1,000 rupees. So you have subscribed to the bond, and suppose that carried a coupon rate of 9%. That means the person who bought a bond for 10-year bond, he'll get 9%, 90 rupees as interest every year per 1,000 rupees. So how many number of bonds you have bought, you will get multiplied by that as a return on the bond, which is 9%. Is that okay? Now what happens is, if suppose that, because this bond was issued about say 3 years back, currently the rate of interest is only say 7%, because now the fresh bond which will be issued by the same company will be issued at 7%, because the interest rates have dropped now in the market, because interest rates keep changing. So whatever the interest rate was there about 3 years back, it will not remain the same after 3 years. The rate of interest may either go up or go down. So now the rate of interest is 7%. As an investor, suppose you want to buy this bond, will you get 9% or will you get 7%? If you buy a new bond from the company itself, 7%. Because company is going to say that 9% bond was old bond, so people are holding that bond, they'll get 9%, but when we'll be issuing new bond, it will be issued at 7%. So in the primary market, that means in the market where you go to the company directly and buy, it's called the primary market. But instead of going to the primary market, you can go to the secondary market, in the stock market, where this bond is traded. This bond, though it is 10 years, but is available in the market. So people, who need money, they can sell it. Okay, people who want to buy, they can buy this bond also. Suppose I want to sell it. I am getting 9%. I want to sell it. I need money because I'll get my money after 10 years from the company. But I can dispose of this bond in the market at a value which is prevailing in the market. Now, when I go to the market and check, it may not be available at 1,000. I want to sell it at, I bought it at 1,000, but I'll check what is the rate. I'll find the rate has actually gone up to 1100. If it was selling at, I bought it at 1,000, it has gone to 1100. It may happen like that. Why? Because the bond, the person who's going to buy the bond from me, he's going to get 9%. If he buys from the company, he'll get 7%. The option is that he can purchase the bond from me. Now, he gets 9% against 7% he buys from the company directly. So, what will happen if I'm selling the bond, it will carry a premium. The price of the bond will shoot up in the market because whosoever buys from me, he is going to get 9%. So, the bond price will start quoting at a higher price. And it will go up to a price where, because if suppose you buy the bond from me at 1100, you are going to get 1,000 rupees only after 7 years. When the bond actually matures, the company is going to give you 1,000 rupees only. You had paid me 100 rupees extra at the time when you bought it. Why? Because you will be getting 9% return. You gave me a premium. That premium is going to be a cost. Now, for incurring that cost, you're getting 9% return against 7%. So the bond price is going to go up and you are going to recalculate what is the return I'm getting. Suppose you're getting 7.5% return by buying at 1100. So from where you will prefer to buy from the market or buy from the company directly? From the market, because if you buy at 1100, you're getting 7.5% return. If you calculate, I'll tell you how to calculate this calculation I'm going to show. So now suppose the price goes to 1150. Now if you buy it, you think, okay, I bought it 1100, let me buy further. But then we checked again, you found that the price has gone to 1150. Then again you calculated what is the return I'm getting. You're getting exactly 7%. So price will keep moving up till it matches with the current rate which is prevailing in the market, where the company is issuing at 7%, you buy from the primary market or from the secondary market, you get no benefit. So the price is going to rise to a level whereby the maximum price it can touch is 1150, where you're getting 7% return. Assuming my calculations are right, you're getting 7% return. So now you can buy it from the company or directly from by me. You're not going to make any difference. You're going to get 7% return. Till the prices touch 1150, you're going to buy out from the market. Is that okay? Is that clear? Now, there is a reverse phenomenon. There is an inverse relationship between interest rate and the bond value. If the interest rates fall, the bond values go up. On the other way, if the interest rates rise up, then the bond value falls. Because if the company is today issuing at 10%, now you're not going to buy from me. If you buy from me, you're going to get 9%. If you buy from the company, you're going to get 10%. So why are you going to buy it? Now you said, okay, let me check. You went and checked the price of the bond which you want to buy. I am holding that bond. And there are so many people who are also holding the bond in the market. You check, it was available at 900 rupees. Bond is at discount because interest rates have gone up, and the people, and I'm getting 8%, 9%, and now you buy the bond from the market, you get 10%. From the primary market, you get 10% from the company itself. So the bond value will fall. It will fall to a level so that you buy it from me at 90 rupees, suppose. So you're getting around 10.25% return. You will buy from me because the company is issuing at 10%, and I'm giving you a discount to the bond, and you're still getting 0.25 more. So the bond price will fall to a level where you get the same return from the market as well as primary market and secondary market will equate. The bond price is going to fall. So there is an inverse relationship between the bond price and interest rates. Now there was one bank which failed a year and a half back or a year back in US. Silver Valley Bank. Silver Valley Bank. Now what happened to that bank? Now the banks are supposed to buy government securities. As a norm by RBI or Federal Reserve in America, they have to invest in bonds. They are necessarily invest to bonds because whatever money they get from the public or from by way of deposits, they can't lend 100% of that money to the corporate world or to anyone as a housing loan or a corporate world, because some money they have to keep it as parked in investments. Okay. And the government says that you have to buy at least 20%. There is a statutory liquidity ratio or various ratios which says that the company needs to buy government bonds. So that entire money is not lent. Some money remains as an investment and as safe as government bonds. So that if there is any problem tomorrow, the bank fails, so bank has money, okay, to take care of that kind of a shock which the company faces. So the Silver Valley Bank. Now again, coming back to this thing, the banks have to buy bonds. But at the time when they buy bonds, they have to declare, that's very important, please listen. When they buy bonds, they have to show that in the balance sheet as an asset, as an investment. उनको investment दिखाना पड़ेगा. Okay. Now, the company can buy a bond, either they want to hold till maturity. जो 10 साल की पीरियड में बॉन्ड है उसके तक होल्ड करेंगे, तब तो बॉन्ड प्राइस नीचे ऊपर होता है, उनको कोई फर्क नहीं पड़ने वाला, because they are going to get 100 whatever the price at which they bought the bond, they are going to get full price from the government, isn't it? So whatever is the price which is changing in the market because of the interest rate scenario, they are not going to get impacted. So any loss or gain they are not going to be worried about. But if they say that we are buying bonds not for holding them till maturity, we are holding them as an assets which we like to dispose of them and sell as and when we require money. Okay, so they have to declare that. Okay, and report the figures in the balance sheet accordingly. So there is an accounting standard which says if you are holding the bond till maturity, you don't have to do anything. Record them at 100% value. But if you are holding the bonds because you want to sell them and you have classified them as for sale, okay, then you have to record them at the current market value. If the interest rate falls, so they will have treasury income reported in the balance sheet. They'll show how much money they have gained because of the bond prices going up, because the interest rates have gone up, gone down, and the bond values have gone up from say 10 crores to 12 crores. So they'll report 2 crores as profits in that year. Unrealized profit, unless they sell. Okay. If suppose they fall, they have to show that, at 11 crore, 1 crore as a loss in that year. So that is called mark to market phenomena. So banks are supposed to follow MTM in reporting the assets if they're holding those assets for sale. MTM is called mark to market. So that means whatever is the value, which is current value, they have to report in the balance sheet. Now, what happened was Silver Valley Bank, they got a lot of money from the startup companies in America. Suppose they got $100 billion from all the startups companies and various people. And at that time, they invested almost, say for example, I'm just saying hypothetically, they invested everything in the government bond. And they are saying we hold till maturity. So they were not reporting any kind of a loss or gain because of interest rate changes. Now, after that, the government of America or the Federal Reserve, which we call Fed raised the interest so many times. The interest rates have gone up after Silver Valley purchased those bonds had gone up by 4.5%. So bond values fell. So actually, they were suffering about 30 billion loss of dollars of loss. $100 billion were actually valuing only $70 billion, but they don't have to report that because they were saying that we are holding to maturity. So we will sell it only when the bond actually matures, and the government is going to give full money to them. But what happened? The scenario changed in America. All the startups, because they have put all the money in bonds, so startups started approaching to the bank that they require money. So what they could do? They had to sell those bonds. And they started selling and making a loss on each sale of bond. And the word spread that the bank is in a dire situation. They're suffering some loss. They're not reporting, but they're still suffering a loss. And everybody, went to the bank and started pulling out their money. And virtually all the money was pulled out of the bank. And banks suffered a $30 billion of loss. Now, the entire accounting standard came into question that, because of the accounting standard, they were not reporting that loss. So the accounting standard was changed, okay, suitably modified so that they can report a loss of that. And they approached, Morgan Stanley and some other, institutions to induct more money. They wanted more equity. So they went to all the financial companies and said, give us loan. But then when they did a, due diligence of the company, they found that company is suffering a loss, but they're not reporting. So the matter further aggravated and it spread everywhere. So company's share price started tumbling down. And the company became bankrupt in a very short period of time. So that was the reason why it happened. It was because of this phenomenon. Okay. Now, debt information. 1 billion in outstanding, face value is 1,000. Today the price is 1,100, which means what? The interest rates have gone up or gone down? What would you say? Gone down. So interest rates have gone down, so bond values have gone up. 1,100, yeah. And coupon rate is 9%, semi-annual coupon. So that means this debt which they have raised, they are going to pay half yearly interest. 15 years to maturity. 15 साल पड़े हुए अभी maturity. Maybe they issued for 20 years. 15 years are still remaining to maturity. Tax rate is 40. What is the cost of equity? First. So cost of equity is simple. Risk-free rate plus beta into the coupon, the rate. Sorry, the 9% was risk premium, market risk premium. So what is the market risk premium? 9%. Risk free is 5, beta is itna. So we simply follow this and calculate the cost of equity. Now coming to what is the cost of debt? Cost of debt is calculated as 4.48. How? So let's do that. Now this bond was selling at 1,100 in the market. If you buy the bond from the market, is going to get 11. You have to pay 1,100. What you are going to get? This much of money for 15 years, half yearly, 30 installment में पैसा मिल जाएगा 15 साल में. 15 साल में आपको 1,000 रुपए वापस मिल जाएगा, 1,000 rupees. Now you want to know what is my return I am getting. What is if I buy the bond at 1,100, I get 27 rupees every 6 months. What is the percentage of return I am getting? The return you are getting is annual return is 4.48%. How I did was I just put my cursor here, go to the formulas and calculate what is my return. This is my return. This is a formula for calculating the return. So I choose everything from here till this. I paid 1,100. I am getting this much. So this was okay. This was 4 point this thing. So now we know we have to calculate weight. So equity is 50 million, 80 rupees the share price, 4 billion. Debt is 1 billion. Current price is 1,100. So 1.1 billion. So we can calculate the weights of equity and debt separately. Just have a look here, bhai. Please. It's not working. So we know that the equity values, there are 50 billion shares, 80 rupees the share price. So 4 billion is the total value of the equity and 1 billion debt. It is trading at 10% more. So it is 1.1 billion. Is that okay? Fine. अब हमने दोनों का वेट निकाला, दोनों को ऐड करा, 5.1 आ गया. 4 divided by 5.1 come to 78%. 1.1 divided by 5.1 gives you 21%. Now, what is the WACC? Which is 0.78 into 15.35 plus 0.21, which is 21% into 4 point. So WACC is 13%. Is that clear? ये समझ में आ गया. अब एक लास्ट क्वेश्चन जो मैं करा रहा हूं, that is cash